So what we're going to do is we're going to start up the class here. In this question, as I said, I didn't like the way it was worded because you had the required. You had basically this and this. We did these two, A and B. There should have been a C because at the very start of the question it said that person was coming to you to see about the lease versus buy decision. And strangely enough, whoever wrote the question didn't bother putting item C, should we lease or buy this equipment, or the building. So I think that's a poorly worded question because I think a student could clearly say, you didn't put it in required. And then Mark would say, well, it was in the question at the beginning. So I think you can get into a little bit of a stand-up. But that being said, let's do it just because I think it's good to learn. Okay, so here, new building. So basically they're gonna lease the land, okay? And the question is, do you want to buy the building or lease the building? Okay, that's basically what they're saying here. The owner of the land is willing to either lease the building under a 20-year lease or have the building owned by the corporation. Okay, so you got, and this is something, when you took management accounting, what did you take, 280 or something? Have you taken 280, 281, whatever that number is, 180? Is there an 80 somewhere out there? I don't even know what you're doing. What's that? 102, is that management accounting?
41.
Okay, so do you guys do make buy versus lease, that kind of conversation? You guys did that in that course, I would assume? So this should be reviewed? Yeah?
Oh, 271.
Okay, 271. Okay, so basically you guys learned about lease versus buy, so this should be a relatively familiar concept, is that right? Yeah? Yeah? Okay, so I'm not going to go very long, it's not going to take very long. Okay, so lease versus buy, what do we do? Like, how do you approach a lease versus buy question? Right? Lease versus buy.
Look at net present value calculation of after-tax cash flows.
Okay. Remember we talked about in class, when you're looking at finance decisions and those sorts of decisions, it's always based on the after-tax cash flow, and it's got to be present value. Because obviously after-tax cash flow doesn't do very much for you. You're getting money 20 years from now. Okay? So to make everything equal, you're trying to compare apples and apples. What you have to do is basically take all the cash flows that they give you, bring them all back to today. So you're comparing apples and apples after tax, right? Because ultimately some things are taxed differently. So to be fair, you have to tax effectively. So that's what we're going to do. Okay, so anybody take a run at this question? Anybody take a run at this question? How did you do it? Hello? Hello? Anybody? Did anybody want to try to help on this question? Everybody looks down. I'm going to go look at my marks on participation. Do this one. Okay, come on. Somebody must have done this calculation. Somebody must have said, okay, how did I do this? Yeah. Okay. I guess not. So it's going to be a lecture today, is it? So it's lease versus buy. The key is always get to net present value of after-tax cash flows for all alternatives. This allows a true apples to apples comparison. Everybody agree? If everything's after tax in today's dollars, everything you do is after tax today's dollars, you can actually compare the two options. Otherwise, if you're saying, well, I'm going to dollars here, dollars there, after here, you're treated that differently for tax, very hard to do the analysis. So the only way to do it is to bring everything back. So option one, let's do the easy option. Lease the building. Okay? Lease the building. Anybody, how do we do this? So the first option tells us you're going to pay an annual lease payment of X. How do we, what's the present value? What's the after-tax cash flow of that? That present value after tax. Okay, so you're basically going to do annuity of $24,000 per year for how many years?
20 years.
At what rate?
I think it's 5%.
Is that what they told us? Well, remember I gave you the discount rate, remember? Remember we gave the discount rate at the beginning of the class?
Okay, it's 10%.
10%. So at 10% after tax. Remember that was one of the issues I gave at the beginning, Janice? As soon as somebody walks to your office and says, I need to know lease versus buy, first thing you're going to tell them is, I need your discount rate, I need your tax rate. Otherwise, you can't do the analysis. Okay, so option one, lease the building. That should be annuity. This thing's got a mind of its own sometimes. So basically, and 33% tax rate, we said?
Yep.
Okay, so what'd you come up with, Janice? Do you have it?
So the annuity rate is 8.51.
So everybody there is, you can do one of two things. You've got a scientific calculator, or you'll get a table that has an annuity table. Okay? And if you have a question that's going to be net present values, we'll give that to you on the exam. Okay? So by virtue of the fact that when you look at the stuff you're going to get for the exam posted, like the free stuff, it's going to have an annuity table. It's going to have some present value stuff that would lead me to believe that we're giving that to you for a reason, yes? So there should likely be something to do with present values on the final exam. Okay? Suffice it to say? I hope most of you can figure that yourself out, but I mean, if not, I just helped you with that. So the annuity rate is 8.51, Janice, so what do you do with that?
So you multiply it to the annual after-tax cost.
Okay, so how do you do that?
24,000 times 1 minus 0.33.
Yep.
And that's equal to 16,080.
How much does that equal?
Times 8.51.
So hey, what was 24 times 1 minus 33? Was
16,080.
080?
Yeah, and then you multiply it to the annual rates, which is
8.51?
8.51.
Yep.
It's equal to 136,898.
136?
Yes, 136,898.
898. Okay. Net present value after tax of lease obligations. Okay? Everybody understands? So basically, by virtue of the fact that you would sign a lease for 20 years at $24,000 a year, given the parameters we gave you in terms of tax rates and discount rate, that commitment is $136,898 after tax, today's dollars. Everybody agree? So now what are we going to do? Now what do we do? Now what do we do? Grab the thing. Okay, so did you do that? Okay, and before we do that, what is that going to tell you? So what if after the after-tax number for the building is higher, buying is higher or lower? Let's say it's higher. What's that going to tell you? Costs more, and therefore you should lease. Okay, so therefore, based on the numbers, you always have to put that caveat. Remember what we talked about? Because you're going to have non-tax considerations, non-financing considerations might say to do something. But so what Katie just said is, we're going to do now the cost of buying the building. And we're going to say, okay, that's the net present value after tax of buying the building. If it's higher, then what that tells you is you're going to do a conclusion that says, based on the numbers, we should lease because the after-tax, the net present value after tax cash flows are lower to lease. Therefore, that's the right thing to do based on the numbers. But if somewhere in the question it says we don't like leasing because our parent company hates leasing or something like that, here's what you're going to say. Just because the numbers say that, well, you can't. There's various things that might pop up in a question and say, just because the numbers say this, you can't go that way. Okay? So that's what basically you're going to see in the question. And they'll prod you with a couple things and everything. So be aware. Not in this question, but on other questions. You will see it. Trust me. When you get into next year, in the next 24 months, you're going to see questions, and they're going to give you a bunch of numbers, and then somewhere in there they're going to put things about the people who are dealing with you. They're going to say, oh yeah, the numbers say yes, but really, you should do this because of that reason. Okay. So always remember the non-tax, non-finance issues when you're going through these recommendations. So we're going to do option 2, by the building. Okay? So Katie, how'd you do that?
Just the purchase cost times 1 minus the tax rate.
Katie, let's just talk about this for a second. So the first thing I would agree with, purchase cost, is what, 225? Okay, 225. Okay, so you're going to go write a check for $225,000. Everybody agree? That's very easy. Here you go, here's a check for 225. And that's today's dollars. Pretty easy to discount that, it's today. Now what I said to Katie is, what else should you do? And Katie said, you were going to take 225 times 1 minus the tax rate. And does that make sense? So you deduct the full 225 today. How do you deduct it? Right. So if this was an operating expense, if this was something you could deduct tomorrow, if the government put in a rule that said tomorrow, buying buildings is fully deductible, then I would agree with you. And we don't have to do all the hard work that we're going to do in a second. Okay? The problem is, it's a capital expense. They don't let you deduct capital expenses right up front. So what they do is, you're going to put it in CCA. You're going to put it in a UCC pool. So, what are we going to do? You want to hand it off now, or you want to keep going?
Did you take off the current year's CCA?
You could, but it becomes a long process.
Okay.
Allison, did you have your hand up already? Jeremy?
So do you have calculated all the CCAs for future years and present value that the current value
Yeah.
subtract out?
Correct. Remember what we talked about, whenever we do an expense, whenever we pay an amount, the government effectively, if it's deductible, the government effectively subsidizes the cost of that expense, right? By virtue of making it deductible, the cost becomes partly paid for by virtue of the tax deduction. So in this case, we have a 225 expenditure, right? But because we do get to deduct that over time, we get some subsidy from the government by virtue of lower tax payments in the future. So what we have to do is figure out what that value is. Okay? Everybody agree? So remember, we just showed it here when we did the lease payment. Take a look what we did here. This 1 minus 0.33 here. Oh crap! Jeez. You guys can't. On my evaluation, you can't say that I say crap too much. Okay? Unless you want to. Wow. New section 1, that's not it. Wow, what happened to you? Class 1 problem. Class 22. Oh, there we go. I don't know what happened there, but that's okay. What this does, what that little box does, ladies and gentlemen, it basically says we pay $24,000 a year. But because we have a 33% tax deduction, which means we reduce our tax payable by 33% of the deduction amount, we only have to wind up paying 1 minus 0.33. So effectively, the government subsidizes part of that expense. So after tax, you're not paying 24, you're really paying 16,080. So we need to do the same thing, apples to apples. Today's dollars, after tax, we have to do some funny stuff with this building cost. So what we need to do is, I gotta be careful here, this thing's got a mind of its own today. So the purchase cost is pretty straightforward. That's $225,000 checks. And Jeremy, how are we gonna do that? How do we come up with the value of the tax deduction? Did you do that? Huh? Jennifer, and I'll get you Andrew next. Jennifer, what did you do?
So then we can use the net CCA formula.
Okay, so tax shield, right? So when you do these calculations, there's a fancy little word that they use. It's called the tax shield, which basically says nothing funny about it. Basically, the deductions create a pool of money that you can deduct. Therefore, it's shielding income. Therefore, it's a tax shield. That's it. So the present value tax shield. So you're going to calculate the present value of those deductions, and there's an arithmetic way of doing it, which is, did you do it?
The cost.
So it's the cost. So let's do this. Hang on here. So now we're going to call this the net present value of the tax shield created by the purchase of the asset. And I would venture to say if you're writing a UFI in 2 years, that's about right, 2 years, right, for you guys? Right, 24 months, pretty well? All right, you guys in third year, right? So in 24 months, if you don't see a tax shield calculation on a UFI, I'd be surprised. I can't speak to the CMA exam. Just somewhere in there's going to be some calculations of tax shields, just because you're going to be asked to calculate what does it cost to buy something, and this comes up. So it is the cost times
The
tax rate
times the CCA rate.
So I would submit to all of you, the numerator is very easy here. No? Look what you do. The cost is $225,000. The tax rate is 33%. That's what the deduction is. If, under Katie's scenario, 225 times 33, that's what you should have as a tax deduction. The problem is you don't get it all today. You get it over time on a declining balance basis. The CCA rate is the rate that's coming in at 6%. So that numerator makes sense, right? That's exactly what you would expect your deduction to be. The problem is it's not all deductible today. It's over time. So now you have to create a denominator, which is effectively a perpetuity, a perpetua, I don't know how to use the verb there, but let's call it a perpetuity, which you're going to introduce here, which is?
So at the bottom is the rate of return, and then to that you add the CCA.
Correct. Okay? That is a formula you should know. Okay? Problem is we have a half-year rule in Canada. This would be if there was no half-year rule, you're done. Okay? So if you have something where you do a rollover and then they say there's no half-year rule applying, you can stop. Problem is you got to do the half-year rule now, so something else happens. Did you do that too? And that's all times.
Multiply that by 1 plus the discount rate divided by 2. And divide that by 1 plus the discount rate.
1 plus the discount rate, right? I'm just going to call this here 1, 1. Okay, so 1 equals the discount rate. Okay? all the VR, that's my initials by the way, fancy here. So it's easy for me to remember this stuff. All that does is basically takes into account the half-year rule. Okay? That's all that does. Okay? So what does that work out to be? Did you get that, Jennifer?
I just forgot to multiply it by
Hang on, I'll give it to you. Okay, I don't want to waste time a lot today on this. 26,578. What's that? Is that what you got too? Okay, so look what happens here. Of the 225 that we paid out, we now get a reduction because we've got the present value of the future tax deductions after tax is 26,578. Okay, so basically you bought a building and it's going to be worth 26,578 deductions down the line. Okay, so in the perfect world that's done. The problem is a lot of times you're going to see questions. I'm going to introduce another concept for you that's not in the case. That'll help you because you're going to see it's more complex than this normally. Is let's say what happens is, so that's done. So basically, I would say, assuming no salvage value, that's the kicker here. Assuming no salvage value, of the building, your net present value after tax equals A, B minus A. Everybody agree? Okay? So assuming there's no salvage value and you continue to own this building forever, that your calculation will be 225 minus 26,578. Do you have that, Janice, what that number is?
Yeah, so the salvage value is 4,000 times 6%.
Hang on. So what's the 225 minus 26,578?
Sorry?
225 minus 26,578, 225,000. What you paid out minus the value of the tax shield,
198,
198,422.
422.
Okay? So that is the value of the building. The problem is, what happens in year 20? Pardon me?
Get the salvage value for it, so the proceeds is $4,000.
How do you know that? Did I tell you that? Can you tell us what the salvage value is? I didn't think they did. Hang on here. Yeah, it doesn't tell you anything like that. Okay? So, the problem is, in year 20, the land lease is up. You now have a building that you own on a piece of land you don't. Guess how much that building is worth to you? For nothing, because basically it's not your building anymore. So what you got to do is, again, they should give you a salvage value here, but they don't. So, because logically you're going to do something to that building, you're probably going to tear it down, because otherwise you're giving a building to the landlord for free. Yeah.
So then don't we have to change the CCA tax shield to subtract out?
Right. So I think it's important. Myself, the way I learned this is to do it 2 steps. This is I own the building forever, and this is the tax shield forever. Now the problem is, in this case, either they give you a salvage value, or they tell you there's a salvage value, you know what it's going to be, we're going to do this, or because the circumstances say you aren't going to own this forever, you need to do something else, then you're going to assume a salvage value. Okay. In this case, again, you can see why these things have become, as you kind of go over the next 24 months, you got to think more. This isn't sort of, like somebody's just going to give you the answer or give you a question and you can just roadmap. You got to figure this stuff out. So in this case, because it's a 20-year lease, the building you bought in 20 years is worth buckets unless you do something with it. And what that's going to be is you're going to tear it down and salvage it. You're going to get some land, some value for the steel, and all that stuff. Okay? So let's assume we have a salvage value. So I agree with you. The issue is I think there's a way, the way to explain it is in 2 steps. You bought the building, here's the tax shield. Now you say, what happens with the salvage value? And what happens when you do your CA exams and stuff? They're going to break this. They're going to give you the tax shield calculation. It's going to be that minus the salvage value in 2 pieces. I like to think of it separately. Okay, you're going to see when you get your UP stuff. Okay, or CMA stuff. So now what we're going to say? Now assume salvage value of 10%. Which is $22,500. Okay? Let's just assume we're going to, at the end of 20 years, we're just going to tear this thing down and have some steel and concrete and stuff, whatever, it's worth some money for us, okay? What happens then? How does that change the world? How does that change the world?
Decreases your net present value, or so decreases your cost.
Okay? So how?
So, because you're selling it, you're getting your money, so you have to get the present value of that amount.
Okay. Step 1 is, think about it. The good thing is, don't think too much esoterically, think about this in real life. In 20 years, salvage value is $22,500. I'm going to get $22,500 a check for $22,500. We need the present value of that now. Yes? $22,500 in 20 years, this is worth $22,500 today. And remember, everything's bringing them back to the after tax. The $22,500 for now is just after tax because somebody's writing you a check. Then we're going to look at the tax effects of getting that check. Okay? The easiest thing to do this stuff is understand physically what's happening, and the tax just follows. So now we're going to do the present value of the salvage cash received. Did you do that? You know what that is?
So it would be 22,500 over 1 plus 10% to the power of 20.
Which equals?
I don't know.
Hang on, I got it for you. Hang on, I'll give it to you. Where the heck do I have that? 430. What was the number?
3,344.
3344. Is that right? 3344? Okay. So that clearly is a reduction in our costs. Okay? Because that's going to be, remember, we're looking at things that are coming into us, what will reduce our original 225 cost. Clearly somebody giving us some of that money back in the future is a reduction of our net cost. Okay, so 3344, good. Okay? That's great. Are you done?
We don't come with the formula tax shield for the salvage.
Okay, because after 20 years, we don't own the asset anymore. Remember what happens in the CCA system. In year 20, when you dispose of that asset, one way or another, you don't have a tax shield anymore. So what we need to do is, step 1 here, is to say, remember up here, this tax shield here, that big fancy thing? that was assuming you were gonna have this building forever and keep taking CCA forever. Problem is, it's almost like a curve, right? Okay, there we go. Your CCA deductions, it's like an asymptotic curve, right? On math people in the class. I don't know, bless you. You know who's the math people here? I know the arts people hate that word, right? Declining down CCA, basically all it means is your CCA will go on forever because there is no zero. It just keeps going smaller and smaller, right? The issue is what happens is in year 20, what happens? That calculation that assumes perpetuity is not the case anymore. So now we got to do is cut the tail off. I like to call it cutting the tail off. This here, we need to figure out what the present value of that is. And take it off because we aren't going to have that CCA for the year forever anymore. So what we're going to do now is, and that's why when you see the calculation of tax shields, they do two things. This one first, and then they take out salvage value, what happens? And the way they do that is by doing this. So, how do we do that? Who was that, Andrew? Did you answer that?
Yeah.
So now what we're going to do is we're going to take off the tail. Take off of the tax shield for the disposition in year 20. See, all these concepts we learned in tax, it all comes back because guess what? You can't take CCA after you sell it. This has to happen. So the rules, all those calculations you get are all basically based on the fact that this is the way it has to work. So how did you do that, Andrew? Did you do it?
So the 22,500
Yep.
times the tax rate of 33%
Yep.
times CCA of 6%,
Yep.
all divided by the discount rate of 10% plus the CCA rate of 6%.
Does that look familiar? This is, look what happens. It's exactly this part, right? The non-half year rule, right? The non-half year rule, because there's no half year rule, because you owned it already, right? All we're doing is saying that calculation in 20 years is gone now. So we just have to we have to redo the calculation, right? So what's that turn out to be?
2780.
She equals how much?
2780.
2784. However,
You gotta discount that back to.
right. Remember, that's $2,784 of future deductions in year 20. We have to bring that all back to today, right? So what we're going to do now is now we have to take that 2784 and discount to today, which effectively means 2784 divided by 1 plus 0.1, the discount rate, all to the 20th, which equals not very much.
414.
414. So of this, look what happens. Intuitively, if you understand what's going on, ladies and gentlemen, it becomes a lot easier to do these things. Intuitively, what they're saying is, of this 26,578 we had as a tax shield when we bought this building, we're not actually going to get all of that. We're going to get less. So what sign should this be? Should this be a plus or a minus? So this number we just came up with here, this 414, is that a plus or a minus? Is that adding to your cost or subtracting from your cost of buying this building? Adding to the cost? What?
Because you don't actually get that deduction.
Very good. So I like to think of it as basically, of this minus number here we put up here, I always go backwards here, this 26,578, we're not getting all that anymore. So that was a bracket, so we're going to get less, so it has to by definition be a plus. That's why I look at it, and if you think of it that way, it's actually much easier to understand. Andrew, does that make sense? The good thing is I'm not smart enough to understand this stuff from basic principles. I have to think about it dollars and cents going into my pockets, and normally it works.
Are we assuming that when we buy the building, we're going to have a salvage value?
Yeah, we have to assume one in this case. Well, in this question, the other option is you assume zero salvage, right? And that's why I think you could. The problem is, what happens in year 20, you still have to assume something happens because you don't own it anymore. You have to assume some salvage value. If it's zero, if salvage value, if you assume you have no salvage value in year 20, what happens?
Well, I was going to ask, does the formula take into account for like any potential recapture or terminal loss?
That's the last piece, right? So remember, so what's happened now is, remember this last piece of the puzzle, that's why you have to remember to do it in steps. if you think about year 20, look what happens. You're going to file your tax return. You have a UCC balance of X. You have proceeds of 22,500. The difference, we have no more assets in the class. So what do two things happen? It either goes negative, and you have, if the pool balance goes negative, what happens? You have recapture. If it's positive, what happens? No more assets left, you have terminal loss. So the good thing is, now we're just going to figure out what's the balance compared to the proceeds. That's going to tell us do we have a recapture, or do we have terminal loss. Then we're going to say, well, we have to pay tax on that. We're going to tax affect that present value. I know this is all German to some people, but you got to think of it through process because there's easy marks in this stuff if you think about it. There's an awful lot of marks here if you ever get a question like this. And it's just literally just click, 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 go by. So how do we do that? How do we come up with? The last thing is need to determine tax effects of disposal proceeds of 22,500. And in your question, if it was 0, you would put 0. You would say assume proceeds are 0. You'd still just do the same calculation, right? Just using a different number. Okay? So how do we do that? Alex.
I have just a question for the formula. Instead of using 22,500 for like coming off that tail,
Yeah.
couldn't we use the opening like UCC?
For which year? For that year?
For year 20.
Well, you'd have to go, if you've got a spreadsheet, I mean, you can do it by spreadsheet too. If you have a spreadsheet, it takes 30 seconds, right? Just basically do open, close, CCH, done, and you have a balance, and you can do it. Problem is, a lot of times you don't have spreadsheets, right?
Is there a way to use like the opening UCC in the formula instead of salvage value?
Well, you have to you have to still compare the two.
Because you can.
You have to compare the two, right? You have to compare UCC and salvage. And they're either going to be one or the other. Either one's higher, the other one's higher, the other one's lower. Has to be. So somewhere you're going to be stuck with comparing UCC and proceeds. What's the UCC number first? We already know the proceeds number. Anybody know how to come up with the UCC number? Georgina, did you know? Alex, you want to take a guess?
So the original cost.
Yep. So
multiplied by-
UCC at beginning of year 20. Let me just read that. And trust me, I know all you guys, when you write your evaluations, how my writing stinks. I know I got it. I'm trying. This is better than it used to be. UCC is at beginning of year 20 is how much?
It's the original cost multiplied by 1 minus the CCA rate.
Okay.
Times 18, and then
1 minus
to the power.
Okay. So the only thing I would say is you have to remember is the first year you're only taking 3%, right? So the first year you're only taking 3%. So basically the UCC pool is 97% of 225 at the end of the first year. Then I agree, then you do 18 years. How did you do that? Then you take CCA for 18 years.
Yeah, so it's multiplied by 49.4 times 18.
Right? Because ladies and gentlemen, you're looking at what's left, right? So 1 minus 06. So this is half year rule. I'm gonna make this bigger, sorry. This is half year rule in year of addition. This is 1 minus CCA rate. Okay, so what we're looking at, so what we're trying to say is, how much is left in the pool at the 225, right? We're trying to look at what the UCC balance is. What you're going to do is basically say, year 1, you're putting 225 in. That year, you only get 3% CCA, right? Half of 6 is 3. So you're only adding 97%. You only have 97% left at the end of 1 year. Then for 18 years, you just continually depreciate at a declining balance basis. So you can just multiply it by 0.94, by 0.94, 0.94 for 18 years. So it's going to be 0.84 to the exponent 18. That will get you the balance at the end of the 19th year, to the exponent 18. That will get you the balance at the end of the 19th year, which, guess what, is the beginning balance for year 20. That is the number you're going to then compare to, right? You don't care what the ending balance of 2020 is, or at the end of the 20th year. You care what it is at the beginning of the 20th year because you're going to take the proceeds out of that. Which, Alex, did you get that number?
No.
Okay, hang on, let me just see. Anybody do it? I get 71,657. Okay? So what that tells me is arithmetically, and you can do it, you go do a spreadsheet real quick thing on your computer, on your Excel. You'll see. Do your CCA by year. That's exactly the number you're going to get at the end of the 19th year. Your UCC pool will be 71,657. And now just put yourself in your shoes. What do you do when you have a UCC pool of 61,657 and your proceeds of 22,500? What do we do? What do we do with that? Allison?
You subtract the proceeds when you sell it, so.
Open year, oh crap. Year 20 is 71,657 less lower of cost, which was how much? Proceeds, which are how much?
22,000.
How much that come to be? 49,157.
Yeah.
So now we have a UCC before CCA. And guess what? All looks familiar now? UCC before CCA is 49,157. What's the problem?
Well, you don't use CCA in the year you just.
There's no more assets in the pool.
Oh, yeah, and you have a terminal loss.
You have no more assets in the pool, therefore you have a terminal loss. This is a terminal loss. That's weird. I have no idea why that did that. No other assets in pool, therefore terminal loss. Tax, after tax, value of terminal loss, bless you, loss equals, what does the after tax value of the terminal loss equal? You get a tax deduction at 33% of the terminal loss. Okay? So the after tax value equals that times that, which is, anybody? 16,222? Something like that? About right? Are we done? So does that increase our amount? Are we? What happened there? What happened there? Someone just said something. Okay, so do we add 16,222 to our net cost as a subsidy? No? Why?
Because that's the value deduct from our income.
Okay, so that's a tax deduction in 20 years though. It's not worth $16,000 today. We have to present value that. Now we have to present value the tax deduction amount. 16,222, all divided by 1.1 plus all to the 20th. What's that equal? 2,411. Okay? So ladies and gentlemen, because we had a terminal loss in year 20, we had a tax value, or tax savings of 16,222. Probably that's not today. We have to bring it back to today. 2,411. So that value is a reduction of the cost of the original outlet. So that becomes a bracket, right? It's reducing the cost. So now, net overall cost of building, assuming 10% salvage equals, it's going to be the sum of, what do we do here? Sorry. I hate when I have to do this on the screen. I don't follow this fast. How far pay? Oh, geez, how far do we have? Okay, here. So it's the sum of x, right? So we basically said the value was, the original cost was going to be 225 minus the shield, gets us to 198. Now we have to take into account the three elements to the salvage, which are going to be this, right? The loss of the tail, the value of, also off the tail, and then lastly, the value of the, the 414 was the present value of the, where are we here? The present value of the disposal proceeds. And then the last one is the present value of the, whatchamacallit there, the tax terminal loss. So the sum of those numbers, does anybody have it there? I'm hoping it comes up to somewhere around 218. Is that about right? Is that about right, Jennifer? You got a calculator? Okay. So the net after-tax cost of the building is $218,081. If I do this right, 25,000. These should all be. Original cost is $250, right? $225. Yeah, sorry, you're right. Okay, that's good. So did I do that right? 225. Hang on here. I put 250 up here though, right? Purchase cost is
I got 193.
193. Hang on here. Let me just make sure I get the right numbers here. Okay, the problem is I used 250 in my calculation here, so I think you're right. 193. Yeah, that sounds better. I thought that was too close to 225. 193?
081.
That's better. Okay. So, 19, yeah, Colin.
Question, when you took off the tail,
Yeah.
why don't we start from 22,500? Because technically we cut off the tail, the amount of CCA that we have left to the future years is basically just our UCC, right?
We don't know anymore.
Yeah. Then after, when you sell it, right? The amount that you can still deduct in the future where you don't own it will still be the amount that if your UCC now account was $1,000. Previously, you would be able to deduct that $1,000 for, let's say, another 10 years or 20 years, or whatever, right? But why would we use 22,500 in this case, just your salvage value, which is totally
Think about it. There's two things, right? You bought the building, you get a tax shield. Everybody agree? Step two is, in year 20, you're going to sell it for $22,500. Let's just say that's correct. So just put yourself in year 20. Three things happen. You get a check for $22,500. Should account for that as a receipt, right? As a reduction of your cost. Secondly, when you get that $22,500, you no longer have an asset in the pool. You cannot take CCA anymore. That CCA is gone. So take the tail off, right? Great. So basically, all we're doing is basically saying, take that tail off. You just figure that? Okay. And then the last piece is, what's that 22,500 versus, because that's what they take out of the pool, 22,500. What's that 22,500 versus the 71? I mean, you might be thinking of it arithmetically, it might work out to be the same, but I think it's easy to think about the three steps of how you would file a tax return.
So it's just salvage value, whatever value that we have.
I think it's the only way to understand this stuff. I mean, I think there's probably better ways to do it, but I think if you think of it in three steps, you sell it, you get cash. Secondly, you cut off the tail. And lastly, look at the difference between where UCC and proceeds are. Come up with a return loss or recapture. Tax affect that. I think it makes some sense, yeah.
So that salvage value is somehow higher than cost. We take cost out as opposed to salvage value. Like,
Yeah, then you have to do a capital gain and all that stuff, right? So you're going to basically do a tax return 20 years hence, okay? Right? So you should know how to do this stuff, okay? Obviously, we spent all of about half hour on this, so I mean, don't go crazy studying to the final, okay? Fair enough.
So basically, when we come to UCC, where does this 0.97 come from, the half year rule?
Tell me where to stop. Wrong one. Where am I here? Okay, so what we're trying to do is, here it is, there. UCC at the beginning of year 20. Okay, so remember all we said is we got some proceeds in year 20. We now have to say what happens from a tax point of view. You clearly have to say 22,500, take it back to today's day, or your present value add. The second piece is, you're filing a tax return in 2020. You have a UCC balance of 71,657. The way you determine that is you put 225 now, right? In year one, you put 225 in. You take CCA. You're only allowed to take half of CCA in the first year. Agree? So basically, your balance at the end of the first year, do the math. Calculate your CCA balance at the end of the first year. It'll be 225 times 0.97. Right?
So how would I come to 0.97? Like, is it
One minus one half of the CCA rate.
Oh, okay.
Okay? Yes? It's half the CCA rate because it's half CCA in the first year. Then after that, you're doing 1 minus the full CCA rate for 18 years. That gets you to day one of year 20. And that's what you're going to compare to the proceeds. Okay? I get you? All right, so now what we're going to do is we're going to have to whistle through the case. And all I'm going to do is I'm just going to tell you how to answer the question and give you some answers. Okay? 'Cause, again, you're not going to get a case next week or 2 weeks from now. So it's more a matter of checking out some calculations and stuff like that. Okay? So what we're going to do is we're going to just go through, where are we here? ICAO number 1. Okay? Okay, does everybody understand? At least you have a basic concept of the process for going through the tax shields and stuff like that, okay? So we would give you the tax shield calculations or annuity tables, whatever you would need in that case, okay? Or at the very least, put it on your cheat sheet if you don't want to memorize it. Okay, so this is an exam question from the ICO from 3 years ago, right? So again, I am not blowing smoke up your anywhere. This is what you're going to see in the future. This is not make believe. And then what basically here is, I love the requireds when they're like this. It says, why is that doing that? Anybody know? Oh,
Just have it selected, so you might have to
what happened?
select it, I guess.
Oh, there we go. That's better. I love when they just say prepare the memo because then you got to go up and look, find out where it tells you what the memo is, which is basically here. So what I'm going to do is try to help you understand how to answer these questions or get your thoughts on how to answer this question. Okay? So basically, this is where it tells you. The exercise requires you to complete a memo to the course instructor that includes an analysis of the taxpayer's income information, or taxpayer's information, and to calculate any preliminary adjustments to taxable income for both the individual and the corporation. Okay? So you have 3 different things going on there, and then the next part is the part that I don't have anything to do with. You must also summarize the audit work, okay? So go take that to your auditing class and ask them to help you with that. That's not fine. I hand it off at the door, okay? So 3 requirements. Analysis of issues, right? Analysis of issues, and then preliminary adjustments for her and for the company. So what you need to do is you need to have 3 different answers, right? 1, 2, and 3. Everybody agree? So you should set that up that way. You should have basically some sort of answer that shows so you're gonna have something that looks like, so analysis of issues, and we're gonna go through them one by one real quickly, and then down below you're then gonna have, what do they call it here? Preliminary adjustments of income, right? And you're going to do that times 2, okay? So you're going to do 1 for the individual, 1 for the corporation, okay? So that's what your solutions should look like. And then the last part is you should have a part B, which will be the audit stuff, okay? So let's just go through what they tell us in the question. Okay, so your CA you've accepted. Basically, you're going to go work for CRA. And I know there's a couple people in class who told me they've actually just they just got jobs with CRA. So this isn't unusual. Exercise gives you financial information and blah, blah, blah. Okay? So everybody good? So what we've got so far is we have to have those 3 required. So when you're reading the required, setting up the response, this is what you should do. So now what we're going to do is just go down. You see a bunch of stuff coming at you, information all like crazy, right? So my suggestion is, like we always do in class, skip over the exhibits first, go to the exhibits with numbers, because a lot of times they give you the easiest things in context. So you see a balance sheet for this question? You see a balance sheet for this question, what do you do with it? Park it. We don't have any capital taxes anymore pretty well in Canada. The balance sheet really is a nice to know right now. It might help you figure something out later. So my suggestion is, you're now going to go to the P&L, right? Okay? And much like we did in class, is there anything there weird? You're looking at 2008, is there anything weird from there? You see anything weird? I don't see anything weird. Basically, they're just telling you to get some dividends, which are the other income. Where here, other income is 30,000, and they have amortization of 23,000. Okay, so those are two things. We should now go back and see what the last page shows you, and you'll see is the page that I suspect what I would do if I were you. I would keep this, rip it out of the exam, and push it up, put it on the side. Make sure you've got that showing somewhere, because that's really the nuts and bolts. Why do I say that? Why do I say that? Why is this the most important page so far we've seen? Yeah, Jim?
Because they already started the calculation and you just have to work from there.
Remember, what one of the requires is, tell us what income much less that you're going to have. Well, this is the income that we reported. So we need to use that as our reference point. So if we come up with an issue and say this should be taxed, we should compare it and say, well, did they declare it as tax or not? Okay? And that's all we're going to do. We're going to basically keep this aside, so I'm going to leave this here. And what I would do is if I were for you writing the exam, I'd pull that page out, put it over here. Usually it's probably more complicated, but this is a pretty simple example. And what you're going to do is just cross-reference and say, oh, that's there, no, it's not there, and you're going to just add or subtract things as you go along. Okay? Because otherwise, there's there are eight or 9 pages here. We haven't seen that so far in this course, right? You got to learn how to kind of weed through all the stuff you get. The way you do that is to take out the priority things, put them over here, and then just work on them. So this is, what I'm going to do is leave that page here. Let's say you're writing an exam. This would be on the side of your desk somewhere, and you're just going to reference it as we go. So that's great. So basically we know we've got to do issues here, and then we have to do preliminary adjustments. Okay? So let's go through. So now we're just going to rattle off what's going on here with this person or company. Where are we here? There it is. Okay? There we are. Okay, a bunch of blah, blah, blah. Nothing there, right? First paragraph, see anything there about issues, tax issues? Or just give me a background, right? Okay, BSL is 4 full-time employees, 2 contract consultants who provide services. BSL hired the consultants 2 years ago and always paid them as independent contractors. Anything in that paragraph you want to talk about? You're working for Revenue Canada. How's
Well, you could talk about like employee versus self-employed.
Right. So the first issue you're going to identify, I'm not going to write it down, guys, just because, I mean, we've hit you with this a few times in the course. The first issue you're going to identify is we need to assess whether or not these independent contractors are indeed non-employees. We need to look at the tests and issue an enumerate the tests. Okay? What are those tests? Everybody remember? What are those tests?
Economic test.
Okay, economic reality.
It was an
Integration.
and
Specific results. Okay? Remember, there's 3 broad tests, and then within the economic reality test, there's 3 subsets, right? Control test, profit test, and ownership of tools test, right? All you're going to do is, this thing you're going to say this. And how we would do that is to assess these tests. That's all you can do. You don't have any more information. You're going to say, we need to assess these tests. Okay, so it's a bit of a jump. It is. But guess what? 3 marks if you know this stuff. And you know what? You're going to get to a professional exam. You may not know all of them, but if you're the type of person at least you get what Calvin just did, like most of them, and speak to them relatively easily, you're going to get a bunch more marks than anybody else does. Because this, half the population, 3/4 of your people who are writing with you, won't remember this as an issue. So why not pick up the easy marks? Whenever I saw tax marks, I laughed because you'll look at the deciles. If you get tax marks, you're in the 90s usually. Because everybody else is like, no idea. Literally, you're going to say people are not going to understand what the heck that means. But if you do, you're going to get a lot of free marks. And you're going to be in the 90th decile, guaranteed. So that is an issue. So you're going to note that as an issue. We need to assess whether or not they're an independent contractor. And how we do that is by looking at the tests that the courts have set up, which are, and lay them out. Okay? Done. Okay? And the last piece of the puzzle is what are the implications of the issue? Is if they're not independent contractors, the company didn't deduct the right amount of source deductions. And and we need to assess them for those. Okay? Everybody get it? So that's identifying an issue, telling what it means, how do you deal with it? That's what you're going to do on these things, okay? Next thing is Sandra receives an annual salary of $80,000. In addition, she is entitled to bonus based on blah, blah. In 2008, the bonus payable was, let's see if I get this the right way. No, of course not. Bonus payable to Sandra was 15. 10 was paid in February 2009. The remaining was paid in August 2009. 12,000 payable for 2007 was paid in May 2008. Jennifer.
So then your annual salary will be included as a deduction for the company and then an income for Sandra.
Okay.
And then in addition, the bonus, for 2008, it was paid in February 2009, 10,000. So that's within the 180-day limit, so you can deduct that.
Okay.
You can include that income.
Yep.
However, the remaining 5,000 was paid in August, so then it's after 180 days, so you cannot.
Okay, so you have an issue here for the corporation. So what you're going to do is you're going to lay it out, right? You're going to have issues for the individual and issues for the corporation. And what you're going to do, you're then going to dovetail into adjustments that you're proposing. In this case, what they tell us here is the bonus payable, where is it here? The 2008 bonus was payable Sandra 15, 10,000 paid in February 2009, 5,000 was paid in August 2009. That's after the 180 days. Therefore, that $5,000 payment in August 2009 will not be deductible in 2008. It will only be deductible in 2009, the year paid. So issue identification, and what are you going to do about it? Right? So you're going to say that in your analysis, and then below that, now what you're going to do is in your little schedule that shows that adjustments. Here, there's preliminary adjustments of income. For the company, I'll talk to Professor Mark and see if we're allowed to post this. I don't know if we're allowed to post a solution. Problem is there's a lot of stuff in there. In the adjustment column, you're now going to take the original number that we got here for the company, here, right? You're going to take that number and you're going to add back $5,000 of non-deductible bonuses, okay? Next, Janish?
Yeah, also, for like issues, or just like tax issues, or whatever, like, are those more or less just adjustments that we need to make, like when they say, like,
Well, some of them will be
tax
non-issues, some of them there won't be an adjustment. So what you're going to do is you're going to go through and talk about what the adjustments are. Okay?
Okay.
Okay, so what you're going to do is just adjust as you go. Okay, so this is a good review for the final because we're just going to rattle off a bunch of things here now, okay? Okay, so any other issues with that paragraph? Katie?
For her personal return, she has to include the amount received in 2008, but
Exactly.
the amounts receivable.
Take a look at what they said she reported in her income here in 2008. 120, which was 40 and 80. Do you see her reporting the bonus? She didn't report her income properly. So we're, on her side, you're going to say she's supposed to report it when received. She didn't record it in 2008. We need to take her 120 number and start an adjustment column as well. 120. Now we're going to add back the bonus that we just talked about, which was how much? $12,000. So now you're going to have a schedule that shows her reconciliation of $12,000. Okay? Pretty good? Next sentence. Sandra drives a Lexus. Blah, 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 blah. Okay, what's this issue? Who haven't heard from today? Samantha, do you want to know?
Since it's a lease, there's a baseline charge and there's also operating costs, perhaps.
Okay, very good. So the issue will be, because the company leases a car, that means there should be a standby charge. And when there's a standby charge, there needs to be an operating benefit. They're hooked together. As soon as you have a standby charge, you automatically have the operating benefit. One follows the other. Remember we talked about this in class? So you're going to do a calculation of the standby charge, and I'll give you this number in a second, of the standby charge and the operating benefit for this lady. And what you're going to do is you're going to compare it there. What did it say about a personal return? Do you see anything to do about a car benefit there? Reporting it? So on your reconciliation and proposed adjustments, you're going to say, add standby charge, add operating benefit. Okay? And then the numbers for those two. The operating benefit I get, standby charge is 6266. Just write this down and you can prove it as you're studying. And the operating benefit should be 3072. And remember what you're going to do on this question, ladies and gentlemen, is the first thing you're going to do is look at the kilometers, right? So as soon as you see a company provided car, you're going to do the assessment of kilometers. right? Because the assessment of kilometers will tell you two things. What is it? Okay, we haven't heard from today. Anybody haven't heard from today? We're running out of time. Class participation class. Okay. What do we do?
Well, it'll tell you if you're in that penalty box.
Okay. Right. So you're going to basically, I said, are you eligible to take advantage of the two good elements? If your business percentage is more than 50%, you get two good things. Number one is you get to reduce your standby benefit to the number of personal kilometers. And number two is you get to take the advantage of the lesser of calculation for the operating benefit. If you don't remember what that means, just write it down. Just remember that because you should know that stuff. So as soon as you see company provided car, you should say company provided car, therefore standby charge, operating benefit, and go and calculate it. But before you calculate, you should say what's the percentage of business usage? If it's greater than 50, you get to do reduced standby charge and choice on the operating benefit. So effectively, you get the lower of both of those numbers, the best case scenario. Okay? If it's more than 50% or less than 50% business, you get hit with a gigantic standby charge, and you get 24 cents a kilometer on your operating benefit. Okay? Everybody remember that? So I told you the number. Okay? It's a good review process. You should prove that number. What's the other piece of the puzzle here with respect to the car? Anybody haven't heard from today? Nobody? Yeah.
Does it have to do with the list price of the vehicle that
Right.
can only be up to 30,000?
So now you're going to go over to the company part, the company adjustments, the company issues. Because you have a $54,000 car, you got to do that maximum lease payment calculation. Remember the $800 a month? And the list price maximum 30,000 times the tax rate. I will give you the add back, okay? Everybody, should not be German to you. You're only 2 weeks away from understanding this stuff and putting it on an exam. So if you don't understand it now, get studying, okay? And by all means, on Tuesday next week, if you don't understand this stuff, bring it to the class and I'll answer how to do the calculation. But basically, what was that calculation for the company? It is $10,849. Okay, was the amount that you're allowed to deduct? It deducted 14,040. Where am I here? It's up here. Right here. So you're allowed to deduct 10,849, which is the lesser of. They deducted 14,040. So your adjustment's going to be the difference between the two. So 3191. Okay? Everybody good? So 3191 is your adjustment for the fact that they leased a really expensive car compared to what they paid. Okay? BSL pays annual dues of $410 and $5,200 for the local golf club. Any adjustments? Katie, what do you got?
For the golf club, the company
Okay?
can't deduct those.
Okay? Easy one always. You see golf club, non-deductible. So for the company, they cannot deduct it. So you're going to say non-deductible expense in your analysis, then you're going to go and add that on your schedule of issues or adjustments. Yeah, what else?
But then she could deduct it because it says she gets a lot of contacts from it for the business.
She can't deduct it? What does it mean? She didn't pay it.
Oh, never mind, sorry.
What are you going to say?
That she can.
What you're going to say is not included in her income because it's principally for the business benefit. Right? So you're going to look at both sides of the equation, right?
Right.
Everybody? Two sides of the equation, if they give you both sides. Number one is her side, not included in income, the membership, because it's for the benefit of the principally. For the company, they're not deductible regardless. What else you want to say?
For the professional dues, she has to include the amount of income, but she can also deduct it later.
Okay. So the company paid for it, so she can't deduct it.
Oh.
Okay? So the question is whether or not it's included in her income. So this is one of those where I'll just cut you off real quick so I'm going to get through. This is for the benefit of the company, so it's deductible for the company, not includable in her income. Okay? Deductible for the company, not includable in her income because it's for the benefit of the company. Okay? I think you could easily argue a lady who's an HR, her membership and an HR membership. Otherwise, none of you are going to like that. You're all going to ride on the coattails of that in about 24 months when you're in a CA firm and they're paying their dues. It's the same thing. They deduct it, and you don't include it in your income because it's needed for your professional job.
Wait, can you just say that it's not deductible because they can't deduct all expenses? Or am I just fully
So what did you say?
Can you just say that you can't deduct it because it's for golf expenses?
Golf, no, she's talking, Katie's talking about the first one, the annual dues.
Oh.
There's two things at the same time. So golf, not deductible to the company, not deductible to the company, but not included in her income because it's for the benefit of the company. The membership dues in the HR place is not includable in her income because it's for the benefit of the company, and deductible for the company because clearly they're paying it for a reason, and that's for her to get contacts. Okay, in order to obtain lucrative contracts, she spends a bunch of time on entertaining, blah, 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 travel, blah, blah. This is very straightforward. All you can say is meals and entertainment, 50% deductible. Okay, that's it. The rest of it is all good. Clearly, it's for the benefit of the company, so it's no income inclusion for her. Okay? So what you're going to just do is toggle between her and the company and just look at if there's issues for one or both. This one, no issue for her. Company only gets 50% of the entertainment deductions. Next one is the loan for the house. Have you guys taken, when you took 201, you guys did take employee loans and shareholder loans, right? Okay, that's for the next, when you do, when I see you in 18 months. All you need to know here is, company lends you money interest free, what are you going to say? For now. The answer is a little bit more complicated, but it's deductible to the company. Why?
Because it was really set by the law, but you can.
Okay, but you have to make sure there's something going on first. For the company to get the deduction, something has to happen first. The employee has to have a benefit. Remember we talked about this? If the company lends money to an employee, you're always going to have a benefit. Period. Right? It's a benefit. The question is if this was a home loan, so you get that 5%, that 5-year haul every year you readjust the 5-year, remember the lesser of? We're looking at like the 3 heads. Okay? Remember we talked about when the company lends money to an employee to buy a house, that's an employee, a house purchase loan, a home purchase loan. You get to use every 5 years, you get the lesser of. This is a home purchase loan. Okay? And then you're going to do a calculation of the benefit, the deemed benefit, lesser of. Remember everybody? Is this German to everybody? Prescribed rate minus the rate you pay times the principal tells you how much your benefit is. Okay, guys, I'm a little bit concerned as you look at me. I got 3 heads. Does this all look familiar? Guess what? This is the ICO exam. Whether or not you get the right duty. This is all stuff you're taking. So it's not like this is stuff you won't expect to see someday. BSL provides all employees with health insurance coverage and life insurance times 3 times coverage. Okay, and then they're going to go through and tell you what they are, right? Basically, the limitations. All you got to remember is benefits are not includable in the employee's payments except for life insurance. So guess what happens here? They tell you life insurance is $4,000. That $4,000 portion of life insurance of the group benefit plan, you can add that to her income. Yes? And then the RPP, there's a matching thing. You're going to do that little calculation which says, as long as it's paid in the year or within 220 days, the company can deduct it, provided it's less than the money purchase limit of 18% of the salary of that person. So she makes $100,000. Clearly, 2,400 times 2, 4,800 is way less. You're good. Okay. You just have to remember those rules. Okay. The last one, determining some employees had to pay $8,000 to successfully dismissal of suit by bill. Any issues? Issue there? That's a fully deductible expense, right? Any legal expenses paid to defend yourself in a business setting is deductible. Okay? That's it.